Red flag number 2. The US credit card debt. As of mid-2024, the average credit card interest rate in the United States is around 20% to 25%, give or take. Here is the history of the credit card interest rate in the last 15 years. Going back from 2009, 2013, the interest rate was between 12 to 15%. After the 2008 financial crisis, the Federal Reserve slashed interest rates to near zero. This is when they're trying to stimulate the economy. So the interest rate for the credit card during this period of time were much lower. Going into 2014 to 2016, the interest rates on credit card were between 13 to 16%. As the economy began to recover, the credit card interest rates started to rise slightly, not too much, step by step. The Federal Reserve maintained a low rate until the end of 2015, when it initiated the first rate hike since the financial crisis. However, the impact on credit card rate was just gradually at that time. This is when it started to get a little bit more interesting. Between 2017 and 2019, when the credit card interest rate went from 15% all the way up to 18%. During this period, the Federal Reserve steadily raised the interest rate as the economy showed that they were getting a little bit stronger. So the credit cards interest rates followed this upward trend, reaching a higher level as the cost of borrowing increased. Going into 2020 and 2021, interest rate on credit cards went from 16% all the way up to 20%. We all remember during the time when we were locked in and weren't allowed to go out. During this time, that time prompted the Federal Reserve to lower the interest rate again to nearly zero in year 2020. However, credit card interest rate did not drop as much as the other interest rate because of the credit card rates are influenced by multiple factors, including risk and the lender's margin. So year 2022 to 2023, the interest rate on credit cards now are reaching between 18 to 22%. As inflation surged in 2021 and 2022, the Federal Reserve began an aggressive series of rate hikes, starting in March 2022. Credit card interest rate climbed a significant amount during this period of time, reflecting to the higher cost of borrowing. And here we are, 2024. We've got interest rate between 20% to 25% on credit cards. By mid-24, the average credit card interest rate were higher than the previous year, reflecting on the cumulative effect of the Federal Reserve's rate hikes aimed to control inflation. So in a nutshell, the average credit card interest rate increased by approximately 60% since 2009 until 2024. So let me give you an example on how crazy that is. If you had a credit card debt of $100,000 back in 2007, just at the start of the financial crisis, and you were unable to make any payments at all until today, 2024, with the interest rate gradually increasing from 12% 2007 to 22% 2024, your debt would have grown to approximately $1.742.248 million. The debt increased by approximately 1,642% from year 2007 until 2004. That's 16 times your money. But there is a bigger problem: the US debt. The US have always carried a national debt, and the majority of the president that have added to it. However, total national debt has been expanding rapidly since 2008 due to the combination of the increased government spending and the failure to raise taxes. As you can see, the big increase in debt between 2019 and 2022, as we all remember what happened between these years. So let's take one step back. So at the moment, the US GDP is about $30 trillion to round it up, and their debt is $35 trillion. So they're spending more than what they're making. So to get a better picture of how the economy of a country is doing is to find out the country's debt to ratio. Now, what is debt to ratio? Let me explain. Debt to ratio is the following. First, you take the debt and divide it with the country's GDP, which is like the country's paycheck. This ratio shows how much money the country owes, its debt, versus how much money it makes, its GDP. It's It's like comparing your credit card debt to your yearly income. What does this really mean in numbers? So let's take US for an example. So looking at the US numbers today, the US owes about 122% of what it makes in a year. So what does this actually mean? For the US, their debt to ratio today is 122%, which means that the US debt is 122% more than what they actually are making. Simpler terms, imagine that your personal debt is 122% more than your yearly income. It's going to be very difficult for you to pay back your debt. So I spent the last couple of days looking at other countries' economy, and I stumbled on Japan. So what I did, I calculated. So today, the national debt for Japan is approximately about 9.4 trillion USD, and their GDP is approximately about 4.3 trillion USD. So this calculation gives a debt to ratio approximately about 218%. This means that Japan's debt is over twice the size of its economy. Japan is in big trouble. That's 2x worse than the US debt to ratio. Red flag number 3, the world is not united. When there's a lot of fighting and disagreement, it creates uncertainty and instability, which can harm the economies. And here's how it works. People and political parties are fighting. In the US, there's been a lot of tension between the Democrats and the Republicans, with people taking either side. If this gets worse, it could lead to series of conflicts like protests and even violence, which could make it hard for governments to function properly. This kind of instability can scare business and investors, making them less likely to spend more money, which can hurt the economy. Civil unrest. If things get really bad, like if people in the US starting to fight each other more, things can actually get out of hand. We've already seen what's happened in the UK this year, and we have different parts of people with different backgrounds start fighting each other out in the street out of nowhere. This could be the beginning of a civil war that can destroy infrastructure like roads, buildings and factories, and this causes a lot of fear that can lead on to a collapse of an economy because of businesses can't operate normally. And then we've got the international conflicts. That's when countries go to war and it disrupts the global trade because of the goods can't be moved freely. This can make things more expensive like oil and food, which can hurt the economy all over the world, which we've seen before. So what we've seen is that Iran have now invaded Israel, and this could lead to a massive conflict in the Middle East, and that region is very important for the transportation of oil and gas. So if the situation between Iran and Israel actually gets worse, this can have a massive impact on the whole Middle East, because this region is so important for the oil and gas production. So if it breaks out even more there, it could cause oil prices to skyrocket. High oil prices will make everything more expensive because the oil is needed to produce and transport almost everything that we buy. So when there's fighting and disagreement, whether inside a country or between countries, it creates uncertainty, and we don't want that in the market. Businesses don't like uncertainty because it makes it harder for them to plan for the future. So when businesses get scared, they might stop investing, hiring, or expanding, which can lead to a recession or even a financial crisis. So to wrap everything up, we've discussed about the US stock market, credit card debt, and the US national debt. Here's what you need to understand and what you can do to protect yourself and even benefit for the next recession. Number 1, the US stock market. So historically, when the stock market becomes much larger than the economy, it often leads to a correction or a crash. And it can even get worse if the Federal Reserve, aka Mr. Jerome Powell, pushes on the gas even more by printing out more money, as they have done in the past to save the economy. This can lead to inflation. While the intention is to boost the economy by encouraging spending, the reality is that more money in circulation can reduce the value of each dollar, leading to higher prices for goods and services. And this can create asset bubbles, where stocks and real estate prices rises to unsustainable levels. Eventually, these bubbles burst, causing the market crashes and economy downturns. Number 2, credit card debts. If you carry credit card debts, pay it as fast as you can, because the amount you owe now can grow quickly in the near future due to the high interest rates. And if the economy slows down, paying off these debts becomes even harder. So it's crucial to reduce your debt now to avoid getting trapped in the cycle of increased debt. Number 3, the US national debt. High national debt can lead to higher taxes or reduced government spending in the future, both of which can slow down the economy. And the government might also need to sell off more bonds to finance this debt, which can raise interest rates and make borrowing more expensive. And one of the best ways to put yourself in the best possible seat is to follow the money. Look what the big institutes and investors are doing. So let's take Warren Buffett as an example. In the first and second quarter of 2024, Warren Buffett's Berkshire Hathaway sold approximately about $100 billion worth of Apple shares. This sale amounted up to 50% of Berkshire Hathaway's Apple holding, a massive reduction on what's been one of Buffett's most important investments. Despite this large sale of Apple, it still remains one of Berkshire Hathaway's largest holdings, but the scale of the sell-off was unexpected and led to significant market reaction. Historically, such large scale of sales by Buffett have majority ended up the market to crash. So let's talk about the Federal Reserve's actions. First, let me explain who they are and what they do. So the Federal Reserve, or the Fed, decides the interest rates that the bank used to borrow or lend money. They're the one that makes that decision. If the Fed raises rates, borrowing money, like getting a loan or a mortgage, becomes more expensive. If the Fed does the opposite, as in lowering the rates, borrowing gets cheaper. This helps to control on how much people spend and save. The Fed also got the magic wand, and that's when the Fed can create more money and put it into the economy when needed. They do this when they think that the economy needs a boost and during the tough time. But if they print too much money, it can lead to inflation, where prices of goods and services go up significantly. The Feds also regulate banks. They make sure that the banks are operating safely and not taking too many risks. This helps to protect the people's money and to keep the banking system stable. One of the main jobs for the Feds is to fight recessions. During the economic downturn or recessions, the Fed steps in to try to help the economy to recover, and it might lower the interest rate or buy bonds to increase the money supply, and making it easier for businesses and people to get loans and keep the economy moving. Anyways, let's go back to what they've been up to lately. So here's a little secret. The Federal Reserve has also been selling off government bonds to reduce the money supply and curb the inflation. So for instance, in recent years, the Fed have sold billions of dollars in treasury bonds. This process, known as quantitative tightening, is meant to prevent the economy from overheating, but it's also a sign the Fed sees a potential risk ahead. So when the Feds take this action, it usually indicates that they are expecting a market crash. I really hope this video have helped you to make the right decisions in the future. And if you want more of these videos, make sure you like, subscribe, and leave a comment. Until next time, thank you very much for watching. Education is priceless.